All right, let's get started. Today, we're talking about consolidation. But I want you to forget about it as some mechanical bean-counting exercise. We're going to treat it as what it really is, a powerful strategic lens for defining the true economic boundaries of a firm. It's through this lens that we can actually start to understand a company's real scale, its power, and ultimately, its value. So let's begin with a really fundamental question, one that every serious investor and strategist has to wrestle with. What are a company's true borders? Is it just the list of legal entities it owns? The buildings on its balance sheet? Or is it something much more substantial? The answer, as you'll see, is at the very heart of consolidation.
To find that answer, we absolutely have to look beyond the ledger. See, consolidation isn't really about bookkeeping. It's a conceptual framework. It's about figuring out the boundaries of the economic organism that an investor actually commands. And getting this right is absolutely critical for any kind of meaningful valuation or M&A analysis.
When we learn to correctly interpret a consolidated financial statement, we're not just looking at numbers. We're reading a story. It's the story of a firm's strategy. The numbers literally narrate how a company uses its power, where it decides to draw its boundaries, and how it plans to generate value across a whole network of different entities.
This brings us right to the central idea, the absolute principle that underpins this entire framework, the principle of control. Now, under IFRS 10, the boundary of the economic firm isn't defined by legal ownership, it's defined by the existence of control. That's the key.
Now, this definition is both very precise and incredibly powerful. I want you to notice what it doesn't say. There's nothing in here about a simple 51% ownership stake. Instead, it focuses on two economic realities. First, you're exposed to variable returns, and second, you have the ability, the power, to affect those returns. This completely shifts our thinking from a simple legal checkbox to a much more nuanced economic assessment. You can think of this definition as resting on three pillars. First, you have to have power, existing rights that give you the current ability to direct the activities that matter. Second, there's exposure. You have to have skin in the game, exposed to returns that go up and down with performance, not fixed returns. And third, and this is the crucial part, there has to be a link. You have to be able to use your power to affect your own returns. You need all three, no exceptions.
And this, right here, is the critical distinction for any serious analyst. Legal ownership can be a facade. Economic control is about de facto power, who's really calling the shots. Think about it. You could own just 40% of the voting shares, but if the other 60% is scattered among thousands of tiny shareholders, you effectively control the company. On the flip side, you could own 60%, but have signed away key decision-making rights in a contract. In that case, you don't have control. It's all about who truly has the power to drive value.
Okay, so let's apply this. When a company establishes control by buying another one, how do we account for it? This is where we get into the acquisition method. But I want you to think of this not as an accounting procedure, but as a valuation exercise. It reveals the economic price an acquirer is willing to pay for things like synergy and future growth.
So, let's put this into practice. Imagine an acquisition. After we've gone through and valued all the assets and all the liabilities, we're left with one final number, 80. So what is this number? Is it just a balancing figure? An accounting leftover to make the math work? Absolutely not. To a strategist, this number is one of the most important signals in the entire deal. It represents the price that was paid for the future. Let's look at how we get there. The acquirer paid $800 for its 80% stake. Simple enough. Then we look at the fair value of that remaining 20%, that's the non-controlling interest, and let's say it's worth $180. So the market is pricing the entire subsidiary at $980. We then measure the fair value of all its identifiable net assets, and that comes to $900. The difference? That's our $80. That's goodwill.
Goodwill is the economic price you pay for all the valuable stuff that you can't individually identify and slap on the balance sheet. It's the present value of all the expected synergies. It's the value of the assembled workforce, the growth opportunities you just unlocked. It is, in essence, a quantifiable payment for future value creation. Now, any astute analyst knows the story doesn't end there. The consolidated statements are full of subtle but absolutely crucial signals that require careful interpretation. We have to learn to read between the lines. Let's go back to that non-controlling interest. This is not some abstract accounting entry. It represents a genuine equity claim on the subsidiary's net assets, held by outside owners. Even though the parent consolidates 100% of the sub's assets and liabilities, the NCI is there to remind us that a portion of that value ultimately belongs to other shareholders. It's a real claim.
And finally, we have to make sure the economic signal is pure. Just imagine a parent company sells inventory to its subsidiary and books a profit. From the parent's standalone view, great, they made a sale. But has the combined economic firm become any wealthier? Of course not. All that happened was cash moved from the left pocket to the right pocket. So, without eliminating these internal transactions, a company could just artificially inflate its revenue and profit. These eliminations are crucial. They strip out all the internal noise so that we as analysts are left with a pure signal of performance that's based only on transactions with the outside world. This is fundamental to assessing true earnings quality.
So after all this, defining the firm by control, valuing the price of synergy, we get to the final payoff. Really understanding these concepts, control, goodwill, NCI, eliminations, it gives you a distinct analytical advantage.
It elevates your entire perspective. You move from a compliance mindset, which is just focused on rules, to a valuation mindset, which is focused on economic substance. You stop seeing a set of financial statements and you start seeing a strategic map of value creation and control. That, right there, is the analyst's edge.
So I'll leave you with this question. The next time you analyze a company's consolidated financials, are you going to see a mere accounting exercise? Or are you going to see the underlying strategy, the true boundaries of the economic firm, and the price it was willing to pay for its future? Your answer is going to determine the quality of your analysis. Thank you.